let's now look at kind of the simple strategy that I want to help you learn, which is a credit spread. So those of you that have never traded a credit spread before, I'm presuming that many of you have, but for those of you that have not, it's an income generating strategy for when you have a mild directional view on a stock or ETF. What that means is that you don't need to have the strong thesis that you believe the stock is going to take off. You think this is kind of the best trades in the market. Just as long as you can identify a stock that's generally trading in one direction or another, that's all it takes to potentially sell a credit spread, which makes it easy for a lot of beginners who are getting started, who may not feel as comfortable reading charts, who may not be as comfortable understanding financial statements and understanding kind of all the complexities that may be involved with understanding a company. But you can kind of look at a chart and say, hey, the stock is generally trending higher, or the stock is generally trending lower, or it's trending sideways. Just basic common sense can allow you to kind of determine a mild directional view, and that's all that's required to get into a credit spread. It also is a forgiving strategy that has a higher probability of success, which is going to help you build confidence. You'll naturally win more than 50% of your trades selling credit spreads, at least credit spreads like the ones that I'm going to show you during today's session. And then the more important part is that it's limited risk and limited reward. So you know exactly how much money you can potentially make or lose before you get into a trade. And this is incredibly important in that last step of preventing blowups. You know exactly how much you could potentially lose. So there's no excuse at the end of the trade where you can say to yourself, I lost too much money on that trade. Because if that's the case, the only person you can blame is yourself for trading too many contracts. And that's, in theory, an easy fix because it has nothing to do with needing to learn technical analysis or trading strategies or anything like that. It's just as simple as math calculating how many contracts you should be trading. Here's a trade idea that I found using our scans, and I'll show you kind of our scans here in a minute. This is Marvell Technologies. It's a semiconductor stock. It is moving higher recently in the last, I'll call it a month or so. And like I said, you don't have to know much about the company. If you can read a basic chart, you can see that the stock is trending higher. It's making higher highs and higher lows. That's all you need in order to potentially get into a trading setup with selling credit spreads. So I'm going to show you structuring a credit spread based on how I would structure it, and then I'm going to walk you through why I structured it this specific way. So we're going to go out to the December 27th expiration, which is roughly 43 days from expiration. And what we're going to do is we're going to sell the $91 put option because the stock is trading just around 91. So we're going to sell the $91 put, the at the money put. That collects $5.75. But so that is a neutral to bullish trade, meaning you would sell a $91 put if you believe that the stock is basically trading sideways or it's going to move higher. Like I said, you have a loose directional view. You don't have to believe that this stock is going to take off. As long as you think that the stock is generally going to stay where it is or move higher, you can sell a credit spread. So selling that $91 put is a way to take advantage of that neutral to bullish directional view. It gives you that bullish view by selling that $91 put, and here you're collecting $5.75. However, if you were to just sell a $91 put, you would be risking $91,000 minus the premium that you're collecting. So we're talking about a fair amount of risk to sell one contract of a put option. Not to mention, you need a substantial amount of margin in order to sell that $91 put. So what we're going to do here is we're going to buy a lower put against that, an $83 put. We're going to pay a little bit here. We're paying $2.55, which brings our net credit down to $3.20 because if we're collecting $5.75 and we have to pay $2.55 against that, that brings our net credit down to $3.20. So we're collecting a smaller amount of credit, but instead of risking $9,100 on a specific trade, as you can see, my max risk now is only $480. So I'm bringing the total risk of this trade down by nearly 95% in exchange for giving up roughly $250 worth of potential income. I'm reducing 95% of risk for $250 worth of potential income. That is the risk. That is the trade-off that I like to make when we're selling these types of credit spreads, and that's what makes it suitable for even small accounts. If you're trading in a relatively small account, a few $1,000s, you don't have $9,100 to throw around every single week. But when you're selling a credit spread, you only have to risk $480. That's something that's far more manageable for smaller accounts. Okay, so in order to understand the strategy, one of the key components to understand is whenever you're trading a vertical spread like this, there's the distance between the strike prices. So the distance between 91 and 83 is $8 per share. Now, if we're going to collect $3.20 out of the $8 that is available, that is the amount of capital that is at play. Because whatever you can potentially make on a trade, which is the $320 that I'm collecting, the rest of the $8 is your total risk, right? So if you're collecting $3.20, the rest of the $8 is $4.80. That's going to be your total risk. And this relationship between risk and reward is incredibly important for you to understand in terms of understanding the strategy from a fundamental perspective. Okay, so we're going to come back to this in a few moments, but it's important to understand that the distance between the two strikes is what's at play. And if you can collect more income, you're going to risk less on the overall trade. So that's going to be an important element that we're going to come back to here in a couple of minutes. So as you can see, what we have a break-even price is $87.80, and what that means is the $91 minus the $3.20. That comes out to be $87.80. That is the break-even price. So the stock's currently trading at nearly $91. As long as the stock stays above 87, we'll be profitable, right? So this is a very forgiving strategy because the stock's already above 87. It's already above 87 by a few bucks. And as long as it stays above 87, it will be profitable. So let's take a look at kind of the outcomes of this specific trade, right? So I've identified a stock that's trending higher here. I'm trading a bullish credit spread here on Marvell. I've sold the December 91.83 put vertical, collecting $3.20. Let's see how this plays out. So if let's say sometime in the future, the stock rises, right? Either it rises significantly, rises modestly, or just simply stays put around where it is right now. Well, in that particular case, in all three scenarios, I'm going to make my full $320 profit. So if I believe that the stock's going to move higher, I'm going to be profitable, right? I'm trading a bullish trade. But what's really interesting about this specific strategy is that even if the stock doesn't move, I'm still going to make my full profit, the full $320, if the stock just simply stays put to where it is right now. That's really kind of an interesting characteristic, if you will, of selling options is that you can be profitable if the stock moves in the direction you expect it to. And even if the stock doesn't move, you'll still be equally as profitable, right? Not true the same as if, let's say, you were to buy the stock or to buy a call option. Now, let's say in the second scenario, the stock dips a little bit, right? So I think the stock's going to continue its bullish trend, but instead it just consolidates and maybe pulls back a small amount. Well, this is really kind of where the true forgiving nature of the strategy comes into play, because even if the stock pulls back a little bit, I can still be profitable. There's not many instances where you can potentially get the directional view incorrect on a trade and still be profitable. But when you're selling credit spreads, that is the case. Now, you're not going to be as profitable, but you can still be profitable as long as the stock is between 87.80 and 91. And as the closer it is to 87.80, you're going to make zero. The closer it's to 91, you're going to make 320. It's basically a linear scale, depending on where you land in between those two numbers as to whether you make 320 or make zero on a specific trade. But as long as it's within that range, you can still be profitable. Okay. Now, in the third example, if the stock now starts to drop, meaning your directional view is incorrect, right? The stock drops. This is really where you will start to see some losses. Not the full loss, but some loss. If the stock is trading between the break-even price of 87.80 and the lower strike price of 83, you will see some losses up until $480. So if the stock drops to as low as 83, you will see a loss of $480. If it's around 87.80, you'll see a loss of around zero. And then the last scenario, if the stock is below 83, this is really where, you're flat out incorrect on the view. Basically this spike higher was a bit of a false breakout and the stock retreats back into the trading range. If that's the case, you maintain your full loss in this particular trade. And the benefit of this type of structure is that if, let's say, the stock really implodes, right? You buy the stock or you get into this credit spread and some terrible news comes out from a fundamental perspective or earnings comes out and the stock drops 10, 20, 30% overnight. Well, you are to some degree protected because the most you can lose is the $480. You cannot lose more than that, even if the stock goes to zero. So you have protection on the overall loss that you have on the trade, which again allows you to calculate the appropriate number of contracts when you get into the trade. So if you can only risk $1,000 on any one trade, if you trade two contracts of this, no matter what happens, you will not lose more than $1,000 on this trade. So you'll never be in a position where all of a sudden you've lost $3,000 or $5,000 on a trade because it didn't go in the direction that you expected to.